Welcome back. Federal Bank is the next company that, as promised, we are going to be speaking with. So they reported a weak quarter with stress visible in asset quality. Credit costs are higher. We'll be speaking with Mr. Venkateraman Venkateswaran, Executive Director and Chief Financial Officer at Federal Bank. Sir, good morning. Great to have you with us here. Appreciate your time. Prashant this side. So let's just start with asset quality first, sir. So gross slippages have risen to about 1.1%. Net slippage at about 0.84%. Both are higher. So if you look at Q1 of 25, these numbers were 0.8 and 0.4. So 0.8 has become 1.1 and net slippage has gone up from 0.4 to about 0.85 odd percent or so. Could you just detail this out for us? I believe this is stress in the Agri-MFI segment.
Yeah, good morning, Prashant. Thank you for having me. Just before I get to answer your question, I would like to highlight the fact that this has been a very strong operational performance Q1. And typically Q1 is soft for banks, and even our own performance year on year, it's a very strong, operationally strong performance. QOQ, our operating profit went up by 6%. And all the metrics, whether it's the NIM, fee income, other income, has been very strong. To your question on the slippage, the large part of this has contributed by the MFI Agri slippage, which caused this increase in credit cost and the increase in slippages. If you look at rest of the book, the asset quality is stable. There is no, cause for concern, even on a seasonality basis, Q1 over Q1. We don't see much stress. For CV, we are seeing a little bit, which is not something which worries us much. But the MFI Agri is something which has caused this credit cost.
What is the size of the Agri-MFI book, sir?
It's about
which part?
It's about 4,000 crore, Prashant. So as a percentage of the book, it's very small.
Okay. And why did this go up? I mean, any specific reason, any particular geography?
Well, see, we do operate in about 20 states. It's diversified, but a couple of geographies where there was, especially in South, where some states had some government intervention, and that did cause this blip. Having said that, I do want to highlight that we have seen the slippages coming down over the last 2 months. From May is when it has peaked. So the slippage numbers for MFI Agri in June, July, both have shown a downward trend, which gives us belief and confidence that the worst is behind us on this.
And gross and net slippage number, if you can give us, where overall, where will it stand for the full year? In terms of at least a guidance, yes.
Yeah, guidance in terms of credit cost, Prashant, we had earlier guided. I'm still sticking to around the same 55 bips level as credit cost for the full year. And we should be below 1% annualized slippage.
Okay, below 1% annualized slippage. For the full year, sir, you're at 0.6% now, right?
It's 0.8, right? 1.11 is the annualized slippage. Against that, I'm saying it will come below 1.
Come below 1. Okay, so annualized gross slippage will come below 1. Got that point. Let's talk margins as well, because that's a factor playing out across the whole sector. There is some pressure on NIMs. For you, I think net interest margins are just about 2.94%.
Yeah.
Now, what's the prognosis? And we have the policy this week itself. Who knows if we get another rate cut or not?
Yeah.
But how much more pressure before it gets better when the CRR cushion kicks in the second half of the year?
See, if you look at our NIM trajectory in Q1, in fact, our NIM drop has probably been the lowest amongst banks, taking into account the fact that our repo gets repriced at T+1. So a large part of the impact of the repo is already reflected in this NIMs. Having said that, we still have the June rate cut full quarter impact, which will come. 2/3 of it will come in Q2. And we do expect the NIMs to probably go down by another 5 to 10 bips, and it will bottom out at those levels. So around 285, around those levels could be the bottom for us, assuming no further rate cut. And from there, we believe H2, we will start seeing the NIMs coming back. And the second part of that is it's not just the asset side story. What I want to highlight is the fact that we have the best CASA ratio year on year and CASA movement amongst all the private sector banks. And we had 108 bips increase in CASA, and the CASA ratio has also improved sequentially Q4 over Q1. So the liability side benefit is also beginning to kick in and getting reflected in the NIMs.
All right, sir. Hi, good morning. Good to see you, Ben. I missed the loan growth number. What kind of a number are you gunning for this year? I recall in the past you were saying that you'll outgrow the industry.
That's
so
right.
do you hold on to that view? If you could give us a percentage band. And the other part I wanted to focus on is the ROA. Has the ROA bottomed out?
Yeah. See, the ROA for the quarter was 1, and we do expect that it will remain around the same levels in H1, and then we will start seeing it pick up in H2. That's the outlook which we have. And our expectation is that we will get to closer to around 1.15 end of the year. On the loan growth, whilst Q1 has been relatively soft at around 9% growth, but again, one has to look at the details. 50%, nearly 50% of the book is mortgage and home loan where we have not grown in Q1. Despite that, there's a 9% growth, which means that the targeted, identified, mid-yielding segment is where we have seen the growth, and that's where we are focusing on. Commercial banking has grown 5.5% quarter on quarter.
Right.
We've seen growth in CVC. Cards has grown.
No, we have those numbers. Just a quick point. What is your LAP exposure, sir? And small ticket size LAP exposure, say under 3 lakhs?
It's a very small percentage at this stage, Prashant. That is one segment where you'll see a significant step up going forward.
And what's the, Mr. Venkateswaran, to get back to the loan growth, targets for this year? You said that in the first quarter, mortgages and housing actually didn't fire, but you were at 9% growth. Yeah. What's the outlook for the rest of the year, and which segments do you think will drive it? These mid-market segments or the mid-yield segments that you're talking about?
It will largely be driven by the mid-yield segments, which I mentioned. And gold loan, again, the June circular which came, we have seen only 1 month impact of the growth in Q1. You'll see a full benefit of the gold loan growth coming back strongly rest of the year. All the mid-yielding segments, but in corporate also, they will see the mid-corporate growth coming back, and that's the area of focus, and not the top end of corporates. So based on the loan mix change, we do expect the growth to be around 1.2x of nominal GDP. That's the outlook which we have.
Okay. So just to, one point, that LAP, low ticket LAP, you're saying there is significant room to expand. It'll go up significantly, you're saying?
See, the base is so small, so as a percentage, Prashant, it will look higher. But
okay. No, I'm just, across companies we speak to, that is one feedback is that is where a lot of stress is. People borrowing small, in that segment, right, and then putting it to use wherever, and that is developing as a stress point. So that's why I wanted to check.
Yeah, there is a difference. There is a micro LAP and then the LAP, loan against property retail. There is a set, market where, again, it's all about the credit underwriting. And so we are confident that, there is room for us to grow in that.
Quickly, sir, going by what you're saying, the loan growth should be 12.5% ballpark. Going by nominal GDP should be around ballpark 10%, hopefully. Before we let you go, I think gold loan as a percentage of a mix is around 12-13%, right?
Correct, yeah.
Where do you see that number headed?
We can pencil in upwards of 25% growth on that.
On the gold portfolio.
So ideally, as a percentage of a mix, say in the next 3 years or so, it should contribute a far larger chunk as a percentage of your loan book mix. Ideally, where would you like that number to stabilize at?
Over the 3-year period, see, the book also will grow. So,
yes.
Say around 15% is where we are looking at.
Okay, so 15% of the book should be gold loans over the next 3-year period. And growth for this year, hopefully 12%, if not better. Got that point, sir. Thank you very much for joining in, and got to get that perspective. That's Federal Bank saying that these asset quality issues, the credit, the rise in the credit cost, all of that should bottom out basically in the second quarter. Stocks down about 1.5% right now, but the